Hello, everyone. Good afternoon, and welcome to our virtual analyst briefing. Before we start, I'd like to introduce myself. My name is Luis Chito Reyes. I'm with the Investor Relations and Corporate Planning Group of BDO. And with me today, we have our Chief Executive Officer, Mr. Nestor V. Tan, and my colleagues in IR. We have Dante Tinga, Richard Tan, and Catherine Tan. Before we start, we'd just like to show you a brief outline of our presentation this afternoon. So we will start with a macro overview, followed by a run-through of our financial performance last year, a brief update on our digital initiatives, and lastly, our summary and outlook. After the fourth portion, then we will have a Q&A. At this point, I'd like to turn over the floor to my colleague Dante for the macro interview.
Thank you, Chito. Just a quick macro overview. For 2022, we are looking at 6.5% GDP growth, and we believe that there's actually scope for upside with these numbers, especially with COVID-related concerns on the decline and the government appearing to be very keen to ease quarantine protocols going forward. We actually believe that inflation is a bigger concern to our macro forecast rather than COVID, at least going forward, especially if energy prices remain to be elevated. What does this all mean for interest rates? Well, the BSP has said they do not necessarily need to move in step with the Fed, but if you have a combination of an economy in reopening mode and inflation at elevated levels, we think policy normalization is not a question of if, but when and how aggressive the central bank would be with regards to raising policy rates. Next slide, please. The reason we are confident with regards to the macro outlook, at least in the near term, is that mobility has been improving. And since the start of the pandemic, there's been a very close relationship between mobility trends and also domestic consumption. If you look at the chart, retail mobility actually was back at pre-pandemic levels or above pre-pandemic levels in December of last year, slowed down in January, but is again back above pre-pandemic levels in February of this year. Now, we monitor mobility trends not just because of the potential impact to economic activity and GDP forecast, but also because from a bank asset quality perspective, a lot of the sectors and segments that were hard hit by the pandemic and gave rise to asset quality concerns were also those that were subject to the most severe of mobility restrictions, travel, transport companies, etc. Next slide, please. Now, the bigger risk, we think, to our macro forecast is inflation. Inflation erodes purchasing power as well as squeezes corporate profit margins. Remember that headline inflation in 2021 is actually already above the central bank's 2 to 4% target range. And the only reason it came back to within the target range of government was because of the statistical rebasing. They changed the base year from 2012 to 2018. We think, though, the statistical rebasing has no implications on real world or real economic conditions. Also, statistical rebasing does not change the trajectory of headline inflation, which is still very sensitive to energy prices. So as long as oil prices trend higher, we think there's upside risk to the inflation numbers. Next slide, please. So maybe we show the yield curve evolution. Yield curves have actually steepened, indicative of inflation risks and expectations of eventual policy normalization. Now, BSP policy support is actually keeping the front end well anchored, but we think, given the combination of economy in reopening mode, right, that means higher imports, potential deterioration in current account balance, potential peso weakness, and they combine that with elevated inflation. The Philippines is a net food and energy importer. So with commodity prices elevated, given all the geopolitical risks we're seeing right now, you could have a situation where policy normalization, again, is not a question of if it happens, but when it happens and how aggressive the central bank would be in raising policy rates. That's it for me. I'll turn the presentation back to my colleagues, but I'll stick around for the Q&A. Thank you.
Okay, thank you, Dante. At this point, we'll go on to our financial performance. So for 2021, we reported a net income of 42.8 billion. This is 51% higher than the previous years and translates to a return on equity of 10.5%. We'd also like to share that this result is about 97% of our pre-pandemic income in 2019. So we're almost there, just a few points shy. In terms of the components, gross interest income was lower by 8%, and primarily this is due to the cap on interest rates on credit cards imposed by the BSP in late 2020. We've been able to bring down at a faster pace our interest expense, coming from reduced levels of time deposits, sustained growth in our CASA levels, and also lately a reduction in our CASA rates in late 2021. As a result, net interest income ended just down slightly by 2% compared to 2020. On the non-interest income side, however, we've seen strong results coming from fee income and insurance premiums. With the gradual reopening of the economy and improving mobility that Dante mentioned earlier, we have seen fee income growing by over 20%, same with insurance premiums at 21%. This, however, was tempered by a normalization of our trading and FX gains. In 2021, the level of our trading and forex gains has gone back to where we normally see them, which is somewhere between 3 to 4 billion a year. In terms of operating expenses, we saw a 6% rise year on year, but part of this is attributable to the business volumes at BDO Life, and without that, OPEX growth would have been just at around 4%. Next. So overall, pre-provision operating profit was down 5%. We set aside 17 billion in provisions last year. This is equivalent to about 73 basis points in terms of credit cost. But this is representative of a more normalized level for us compared to the previous year where we had the preemptive provisions because of the pandemic. Taxes, we are looking at 27% lower for last year. And again, this is primarily due to the effects of the CREATE law. In terms of our quarterly income results, what we just like to highlight here is that if you look at the lines encircled in red, the three components, net interest income, fee income, and pre-provision operating profit, are all showing a sequentially improving trend quarter on quarter. So again, I think this indicates the sustainability and resiliency of our businesses. And in a period where we hope to see more business activity coming through, we believe that there is a very strong potential for this trend to continue into 2022. Now, in terms of the balance sheet, the growth in our asset base has come primarily from loans, which were up by 6%, and primarily that has come from consumer and corporates. We've also seen a 21% increase in our investment securities, given that the growth in loans was not commensurate to the growth in our funding, and therefore part of the excess funds ended up being invested temporarily in our securities book. On the funding side, deposits overall grew by 8%, but underpinning that is the 13% growth in our CASA deposits. And the balance of the funding side came from the growth in our capital, which increased by 8%. In terms of book value per share, we'd also like to share that the book value per share is up by 8%, and we ended last year at about 95 and a quarter book value. Now, looking at our loan growth compared to the industry, over the last 2 years, we have performed a bit faster than the industry. Again, this is a momentum that we carry forward into 2022.